Oh, man. All right, so I got a bone to pick with Devin Carroll. Oh, Devin, how dare you? All right, so Devin was challenging the validity of annuities, and he said there's only one you should own, and which is a MIGA. And back in my day, we never called them MIGAs. We only called them fixed annuities. I don't know why they changed the name to MIGAs, multi-year guaranteed annuities, but be that as it may. But Devin was adamant against variable annuities, fixed index annuities. I don't know if he got into SPIAs or not, but he did not say anything about SPIAs. So, hey, first and foremost, SPIAs are fine. Absolutely. We can debate all day long about SPIAs, but no one would argue a SPIA is a bad thing. It's just a fact, or not a worthwhile product. Now, they might say it won't be, useful to you for whatever reason, but so SPIA is kind of off the table in this discussion. I want to talk about his proposal about fixed annuities. First and foremost, he said you should not buy a fixed annuity above and beyond the state guarantee limits. I just think that's crazy. All right, so the state guarantee, we'll just say Georgia, I don't know what it is, probably $100,000. All right, so the state government supposedly guarantees $100,000 for annuities. All right, now they don't offer that. They're not supposed to sell that. Not supposed to propose it and all that. But the problem is, if you only make a deposit of under $100,000 when you could have made more, you could be leaving money on the table. Why is that? Because insurance companies, what they do with your money, they take that money you deposit and they go out and they buy bonds. That's literally what happens here. So if you only give them $50,000 to 6 different insurance companies, they only have $50,000 that they can buy. Hey, how are you? They only have $50,000 that they can turn around and buy bonds with. If you gave $300,000 to one insurance company, they have $300,000 which they can turn around and buy bonds with. All right, that's just more bargaining power. They can definitely get better bid-ask prices. They can definitely find better products potentially because they got more money to work with, which is why if you see insurance companies, usually the more you put in, the higher your interest rate is going to be. Perfect example is USAA. Did a video on this the other day. They have a 10-year fixed annuity and paying 5.25. I think you had to put $250 in there or something like that. I can't remember. But if you put less on it, I think it's 4.85. That might not seem like much. That's 35 basis points. 30 basis points, whatever it is, that's 40 basis points. That's 40 basis points a year. It might not seem like much, but $100,000, that's $400 a year. 10 years, that's real money. Anyway, so the point being is, if you only buy up to state guarantee limits, you're limiting the potential upside you get on the annuity. And on top of that, as a state guarantee, is it really the cat's meow when it comes to protection? Show me any annuity company, insurance company, other than AIG, that has been in world dire straits. I'll tell you a couple. There's Penn Treaty. Many years ago, there's an insurer called Penn Treaty. I had clients who bought their long-term care policies in the 90s, early to late 90s. And I was trying to take those policies out. I was like, no. I was selling Genworth. I was selling Lincoln Money Guide Pro, Lincoln Money Guard, I forgot what it's called now. But I look at these contracts, I said, I can't compete with that. They're too good. I remember thinking back then, I said, how the hell are they offering these benefits for this cheaper premium? Well, what turned out is the insurance companies, their actuaries underpriced the benefits they were giving to their insured. They weren't charging a high enough premium for the value, the coverage that they're providing. And so as such, when the claims started rolling in, Penn Treaty couldn't make whole. They're like, we're in a bad place. So what happened? Well, they got bought up by other insurance companies. Did the insurers lose their benefits? No. This is the thing with insurance. Go back to the Great Depression. How many insurance companies went kaput versus how many banks? Now, you could say the banks went kaput because of no FDIC. That's fine. There's no guarantee for insurance companies either back then. Why didn't insurance companies go bankrupt, and why don't they do it all the time? Simply because insurance is a trusting product. If you lose your trust, if you have life insurance, $1 million life insurance policy, I'll pay $250 a month to cover me. So if I plop over, my wife will get paid $1 million. If I have any reason to think that the insurance company will renege on paying my wife $1 million at my demise, I will stop immediately paying the $250 a month into it. I'll set up a side account for myself. I'll say, hey, worst case scenario, babe, I die today. At least got $250. that I would have given to an insurance company that will go bankrupt. Insurance companies have this huge incentive. It's marketplace, man, to say we have to make sure people trust us that we will be there when they file a claim, which is why I still keep my auto and home with USA, because every time I file the claim, they pay out lickety split, no questions asked. Yeah, it's probably pricey, but it's actually not that pricey for the comfort of knowing they pay out quickly and my job gets done fast. There's something said about that. I don't even know if I'm paying a premium so much, but let's just say I am for that level of service and knowledge that it'll be paid out. All right. Then it goes back to VAs. So that's with fixed annuities. I don't think Devin's right at all. Don't buy anything more than the state guarantee. I just don't believe. I think that's not good. And then on top of that, fixed annuities, you don't want to have different companies all over the place. It just don't make that so complex. And look, I'm not saying you go buy a fly-by-night insurance company. We used to have cats insurance when I was raised in the D.C. area in high school. If you're going to get insurance, you'd go to cats insurance. It's always funny because it's just kind of like Eastern Motors, your job's your credit. That was another firm that used to sell cars to people are down their luck, let's just put it that way. At Eastern Motors, that was cats insurance back when I was growing up. They used to advertise it on the urban stations, if you know what I'm saying. Anyway, so now we talk about variable annuities. Devin says variable annuities are too expensive. I don't know that to be true. In fact, I'm older than Devin, and so my experience says that's what I used to think back in the 1990s too. Remember, I come up from Vanguard, all right? So I read French Famine in 1994. My economics professor, Howard Block, he wanted me, he's like encouraging me to go into finance and stuff like that. And so I know index funds. I know John Bogle. I met John Bogle. I cut my teeth at Vanguard. I'm everything. An index guy, 100%. So instead of buying a variable annuity, you just buy index funds and just let that puppy sit. And most likely you'd be ahead with the index fund than you would be a VA, which is unequivocally true. No one would deny that. And the reason no one would deny that is because the variable annuities have fees that index funds don't. The irony of all ironies, you can make the same claim against money managers too, though. I just kind of find this funny. Well, variable annuities have fees, thus bad. Well, money managers have fees, thus bad. If you want to make that claim, I wouldn't make that claim. And you shouldn't make that claim because fees are only bad in the absence of value. What does a variable annuity provide for the fee you're paying? Well, back in the 90s, everyone was saying the same thing about variable annuities. And then they had this professor out of, I want to call it King's College or something like that, out of Toronto, Moshe Milevsky. I'm not sure how to pronounce Moshe because it's like a Hebrew, Moshe. And he was a very hard-charging guy against variable annuities, saying the same thing. He said they're too expensive for what the value you get. And then he ran some numbers. He goes, whoa. He was stunned. He said, I want to price, essentially, I'm going to look at some puts and options, puts and calls, some option contracts, and price them against what a variable annuity is doing, which is the same thing. They're basically buying and selling puts and calls, options contracts to to hedge their risk. He goes, it turns out the variable annuities are cheaper, significantly cheaper for what I can do on my own. And again, going back to purchasing power, more dollars, you can have more purchasing power, smaller spreads on commissions on buying and selling, stuff like that. That's one reason. But another reason, he said, look, they just are. And if you want to go create your own hedge as a variable annuity, you're going to pay more than buying one from an insurance company. Now, you can make an argument, well, the hedge itself is unnecessary. Oh, okay. That's a different argument than saying they're too expensive. Well, they're not too expensive for what they provide necessarily. Now, today might be different. I don't know. But I do know many insurers were desperate to buy out their holders, all right? I mean, I get clients all the time with letters. Hey, MetLife and Pac Life, these companies are trying to buy out my variable annuity contract. I say, yeah, they're not doing that because they're screwing you over. They're doing that because they know they have a liability. Insurance companies aren't dumb. They're like, man, we bought off more than we could chew with what we're costing, essentially, like Penn Treaty and whatnot. I think it's Penn Treaty, most positive it is. But we offered too much for the price we got, all right? Now, blame it on the actuaries. I don't know. I don't care. But I said, hell no. If they're trying to buy you out, they're just trying to catch you at a dark place in your life where you need a quick cash infusion. Don't do it. All right. So anyway, the point being is we have evidence that the insurance companies were not overpricing relative to the value they're getting. Now, was the value you're getting, do you even need that? The hedging worth it? Well, let me tell you something, man. In the late 1990s, if you bought a variable annuity, You were happy as a clam come 2009. Let me just tell you that for a fact. You're like, yeah, I might not have performed as well as the S&P 500. Oh, actually I did, because the S&P 500 was way down. And I did relative to the income stream that variable annuity can provide. Not even debatable. Not even debatable. In fact, I used to sell Ohio National and Pacific Life variable annuities with a 10-year guarantee. This is the beginning of the early part of the aughts, after the .com crash and everything. And people were just nervous getting the market. So we wrapped around annuity. So look, put it there for 10 years, put $100,000 in. We are guaranteed that you will get $100,000 back after 10 years. And there'll be some growth on potentially. Did I get a commission? Yes, I did, a 4% commission. And there's fees, probably cost 1.5%, 2% or something like that. Not a whole lot of bells and whistles we offered on top of that, but we knew for a fact my clients would have 10 years in with me, and they would get their money back, worst case scenario. 100,000 in, 100,000 out after 10 years. Obviously, if the market grew, they would have grown with it minus the fee. And just going back to money managers, to say the variable annuity fee is expensive, like, you don't see where that's going for the value you're getting. Anyway, so the point being is we have evidence, and again, I haven't looked at variable annuities recently, but let's just put it this way. A variable annuity looks pretty doggone cheap when the markets are going nuts. Because what a variable annuity does, in terms of the bells and whistles that are expensive, supposedly, is they're giving you these guarantees from an income stream. They're saying you can't outlive your money. So what usually happens here, you put $100,000 when you're 60, is guaranteed to give you, I'm just using this for example, I don't know if they still do this anymore, but this is what we used to do. After 10 years, when you're 70, you are guaranteed to get $10,000 a year off that variable annuity for the rest of your life, regardless of what the market does. All right. So you put $100,000 in. Well, that stinks. Some stinks around here. It's guaranteed to have an income base of $200,000, for which you get 5% a year off. All right. So that means, without question, it's going to go at 7.2% on the income base. $100,000 you put in. $200,000 will be the income base in 10 years, of which you can get $10,000 a year off that, no less, maybe more, depending on the markets, for the rest of your life. And generally speaking, if your wife on joint annuitants, it'd be not 10,000, it'd be 9,000, it'd be 4.5%, because you're covering two lives. Now, that might not seem good. You say, look, Josh, after 10 years, if I put $100,000 in the S&P 500, and it grows at 10% a year, it'll be worth $300,000, in which case I can get $15,000 a year as opposed to 10. Yeah, that's exactly right. You could, but it could also be worth $70,000, which now you're getting 3,500. Yeah, 35. What did I say? Yeah, it could be worth $70,000, which you're getting $3,500 a year as opposed to $10,000 you could get with a variable annuity. Now there are fees for that variable annuity. Were those fees worth it or not? Now, I think most income people would say, yes, they were. Now, if you don't need the income, you got Social Security, pensions, you're working, whatever, you're a baseball card collector, you're selling your Ken Griffey Jr. rookie cards, yeah, it's probably not worth it. But I just say variable annuities are inherently bad or expensive. That's crazy talk, man. It's just simply not true. Simply not true. Now, I don't know anything about fixed index annuities. I will say again, though, as I've done before, the nice thing about fixed index annuities is at the end of the day, there is a bottom. You say, at the end of the day, I can't lose money. Now, what is Warren Buffett's number one investment thing? Rule number one, don't lose money. Rule number two, see rule number one. Now, is Warren Buffett a globalist scumbag? Of course he is. Does that mean he has no good knowledge? Of course, that'd be silly to say. So if it's good enough for Warren Buffett not to lose money, an index annuity will provide that to you. Now, these idiots are out there, fixed index annuity is better than a 401k. These guys are just better than the Roth. That's stupid. I hate that crap. Hey, puppy! Woo! Love you! The dog just rode by. I think I scared the driver. So that's what I do. I'm a scary monster. Anyway, point being is, unfortunately, annuities get a bad rap. And it's too bad because annuities have huge roles to play in many financial plans. And people like Devin are very smart. I wish they'd look at the other side of this actually and say, hey, annuities are expensive. Why? Why are they expensive? Because we can easily say the same thing, money managers. Money managers are expensive. I say, why? Why are they expensive? Well, they're expensive because I could get better rate of return in the index. Well, of course you could. Of course, if we're comparing just rates of return, then it'd be silly to put any fee on any product at all, ever. And this is the thing with these money managers, man. I don't think they realize. I don't know how Devin gets paid. I have no idea. I'm not even sure he's a money manager. I just don't know. But the problem with these money managers, when they say other products are too expensive, we can easily look at them and say, you're too expensive. And then they'll have to backtrack. They'll say, no, I'm not too expensive because I offer this, that, and the other. I said, well, the same thing with variable annuity, man. It offers the same thing. He's value added. Again, you can make an argument you don't need those things, but then I'd say, let's look what happened from 2000 to 2009 and tell me, did that annuity do well for income needs or did it not? And the answer, of course it did. This is the problem with me. I've been around for so long. You start to see the same arguments regurgitated about various products. And it's annoying because, like, we've already solved these arguments, and then it comes back in shades like, oh, man, we're doing this again. And the same thing with money managers. I'm not against money managers. I used to be one. People say never beat the index. I say, you won't either. What are you talking about? Just buy an index fund. I said, the index fund inherently has a fee on it. Might be 4 basis points, but inherently you'll never beat the index. Why? Because you can buy the index fund, which has a fee, a money management fee. Well, come close, okay. But you're saying as a money manager, you'll never beat the index. It's simply not true. I mean, it could be true, I don't know, but you won't either as an individual investor. Anyway, so stick with me. I'll take you there. I'll show you what's what. And if I ever meet Devin, I'll pat him on the back. He's a good guy. He actually called in one time when he was on vacay. What was he talking about? I forgot what we're talking about, but, he called in. I forgot what we're talking about, actually. It might have been Trump's Social Security thing. I forgot. But, no, when it comes to Social Security, Devin's spot on. On this topic, though, I'm not saying he's wrong. I just got a bone to pick. I'm a defender of annuities. That's what I am. The defender with my crazy hair of annuities. All right, God bless. We'll see you.